The higher they go, the harder they fall. As enduring and to told you this kind of bull market baloney, Graham urged the intelligent investor to ask some simple skeptical question. Why should the future return of stock always be the same as their past return? Whenever investors come to believe that stocks are created to make money in the long run, won't the market end up being wildly overpriced? And once that happens, how can future return possibly be high? Graham's answer, as always, are rooted in logic and common sense. The value of any investment is always must be a function of the price you pay for it. By the late 1990s, inflation was withering away, corporate profit appeared to be booming, and most of the world was at peace. But but that did not mean, nor could it ever mean, that stock were worth buying at any prices. Since the profit that companies can earn or finite, the price that investors should be willing to pay for stock must also be finite. Think of it this way: Michael Jordan may have been the greatest basketball player of all time, and he pulled it into Chicago Stadium like a giant electromagnet. Like a giant electromagnet, the Chicago Bulls got a bargain by paying Jordan up to $34 million a year to bounce a big leather ball around a wooden floor. But that doesn't mean that the Bull would have been justified paying him $340 million, or $3.4 billion, or $34 billion per year, per season. The limit of optimism, focusing on the market recent returned when they have been rosy, warns Graham, will lead to a quick, illogical, and dangerous conclusion that equally marvelous result could be expected for common stock in the future from 1995 through 1990s. As the market rose by at least 20% each year, a surge unprecedented in American history, stock buyer become ever more optimism. In the mid 1998, investor survey by Gallup organization, the Weber brokerage firm expected the portfolio to earn an average of roughly 13% over the year to come. By the year 2000, their average expected return had jumped to more than 18%. Sophisticated professional participants bullish, jacking up their own assumption of the future return. In the 2001, for instance, SBC Communication raised the projected return on its pension plan from 8.5 to 9.5%. By 2002, the average assumed rate of returning of expansion of pension plans of companies in the Standard & Poor's 500 stock index has swollen to a record high 9.2%. A quick follow-up showed the awful aftermath of excess and enthusiasm. Gallup found in 2001 and 2002 that the average expectation of one-year return on stock had slumped up to 7%, even though investors could buy at a price nearly 50% lower than in 2000. Those gung-ho assumptions about the return of their pension plan will cost the companies in the S&P 500 a bare minimum of $32 billion between 2002 and 2004. According to recent Wall Street estimated, even though investors all know they're supposed to buy low and sell high, in practice they often end up getting it backward. Graham warning this chapter is simple. By the rule of opposite, the more enthusiastic investors become about the stock market in the long run, the more certain they are to be proved wrong in the short run. On March 24th, 2000, the total value of the U.S. stock market peaked at $14.75 trillion. By October 9, 2002, just 30 months later, the total U.S. stock market was worth $7.34 trillion, or 50.2% less, a loss of the $7.41 trillion. Meanwhile, even market pundits turned to sourly bearish, predicting flat or even negative market return for years, even decades to come. At this point, Graham would ask one simple question. Considering how called Sheila and Braun expert were the last time they agreed on something, why on earth should the intelligent investor believe them now? What's next? Okay, so this is just like some calculation. You can read it. Instead, let's tune out the noise and think about the future return as Graham might. The stock market performance depends on three factors: real growth, the rise of the company's earning and dividends, intentionally growth, the general rise of the price throughout this economy, speculative growth or decline, any increase or decrease in investing public appetite for stock. In the long run, the yearly growth in corporation earnings per share had averaged 1.5% to 2%, not counting inflation. As the early 2003, inflation was running around 2.4% annually. The dividend yield on stock was 1.9%. So 1.5% to 2% plus 2.4% plus 1.9% equal to 5.8% to 6.3%. In the long run, that means you can reasonably expect stock to average roughly 6% return or 4% after inflation. If the investing public get greedy again and send stock back into orbit, then that speculative fever will temporarily drive return higher. If instead investors are full of fears they were the 1930s and 1970s, the return on stock will go temporarily lower. That's where we are in 2003. Robert Shrivel, a finance professor at Yale University, said Graham inspired the inflation approach. Schiller compares the current price of the Standard & Poor's 500 stock index against the average corporation profit over the past 10 years after inflation. By scanning the historical record, Schiller's shown this ratio goes well above 20. That market usually deliver poor return afterward, but it dropped well below 10. Stock typically produce handsome gain down the road. In early 2003, by Schiller math, stock were priced at 22.8 times the average inflation adjusted earning of the past decade, still in the danger zone, but the way down from the demand level of 44.2 times earning in the December 1999. How has the market done the past when price around today level? Figure 3 to 1 show the previous period when stock were similar high and how they flare over 10 years stretched that figure. Okay, so that's just like the what's next. You can pause the video to read it. Okay, thank you for coming. Have a good day.